There we go.
When's the last graded homework assignment?
The last graded one is the chapter before we did that experimental chapter. I haven't downloaded those out of my accounting lab yet.
All these homework now is extra graded?
Huh?
Is all these extra?
Oh, that's a good question. How many have we done so far? I don't remember. You only needed to do 6. So that would have given you the full credit for the homework. So, and we've got, I don't know, 10 chapters. So
anything above that, though, you're going to be...
yeah, but it adds to the 500. So it's exactly what you said. It's extra credit. Absolutely. So, I mean, there's no reason not to do the homework because it helps you prepare for the exam. So, all right. So exercise number 13 on page 39. We have, this is a payroll tax. That's the big calculation in this, this particular one is determining what payroll tax is and how you book it. So you have a total payroll of $500,000. There are 2 payrolls. They give you information. Out of that $500,000, the people that have reached the $100,000 limit, which for this particular problem is the FICA limit, is $350,000. So they have reached that limit. So most people have met that one. Overwhelmingly, 400,000 have met the $7,000 limit that unemployment tax is applied to. So those 2 will tell us how to calculate the employer portion and employee portion of those 2 taxes. And then there's income tax withheld and some union dues withheld. And then it gives you what the state unemployment rate, the FICA rate, and for the employees and for the employers. They used to be different. A couple of years ago, they combined them, and now they're equal. And then federal unemployment is the 0.6%. So your debit is to salaries expense. And that's the full 500. So in each of these payroll type problems, you're going to have 2 entries. The entry to pay the employees and to book their salaries, and then there's a separate entry that needs to be calculated for the employer-only portion of the taxes that are due. And that's primarily the unemployment taxes. Okay? All right, so you have this, and from that gross wages of $500,000, you're going to deduct the federal income tax withholding. And it gives you that number, 85,000. And then there's FICA that comes out of a portion of the wages. So the only people that are remaining that pay FICA are those that have not reached the $100,000 limit for purposes of this exercise. All right? So, because once you reach your FICA limit, you don't have to pay, you don't have any more Social Security deducted out of your paychecks. Now, unfortunately, they keep moving that little carrot farther and farther and farther away. When I started, it was $22,000. So almost everybody, KPMG with overtime, when my starting salary, I used to reach that limit way back when. And then it wasn't until I became a CFO that I started reaching it again, because it's always moving. So you take the total payroll, deduct those that have reached the limit, and then multiply that by the employee portion, which is 6%. And that'll give you $9,000. Because that's 150,000 times 6% is 9 grand. Then you have the union dues. And the problem tells you that was 10,000. Deduct all the withholdings out of the gross pay, and you have what you are paying them in cash. And that's 396,000. That's the employee side of the entry. The employer then has payroll tax expense, they have a FICA payable because employers match. And in this case, the FICA was the 500,000 minus the 350 limit. And the employer was paying 8%. So we're doing the calculations for the credits first, and then when we add all that up, you'll get what the total payroll tax expense is. All right? And then federal unemployment is the 500,000 minus the 400,000 that have met the $7,000 threshold on an employee annual wages. And then the employer federal portion of this is 0.006. And that's $600. And then you have the state unemployment. Yeah, isn't it great? So take that same 100,000 limit, because the 7,000 applies to the state as well as the federal. Take that same 100,000 that is still taxable and now multiply it by the 0.054 for the 5.4%, and you get 5,400. Add all that up, and you get 18,000.
Where did the 5,400 go? Or where did it come from? I'm sorry.
It's given to you in the problem. It says the state unemployment tax rate is 5.4%. The last bullet point in the problem.
Right, you take 5.4%
Times the same 100,000. Okay?
So what about when we were talking about the entries for the employees?
Right?
What about the difference between that cash and that salary expense?
Well, you're sending everything, all the difference between here, the $104,000 is what you're sending to other people. You're sending 10 grand of it to the union, whoever they are. You're sending the remaining $94,000 to the federal government on 2 separate tax returns. You're sending this on one tax return and this on another. And you normally pay those, well, depending upon the size of your company, you might be paying those monthly, weekly, quarterly, something like that, depending upon the number of employees and the total debt. All right? Questions on that? No? All right. Nine -6, non-interest bearing note on page 41. Problem 9-6 on page 41. On this one, on January 1, Northern Manufacturing Company bought a piece of equipment by signing a non-interest-bearing note, $80,000 for 1 year. The face value of the note includes the price of the equipment and the interest. The effective interest rate is an annual rate of 16%. Wow. And the note is to be paid in 4 quarterly $20,000 installments. The price of the equipment is the present value discounted at the effective interest rate. So for this, you have to go to your tables. And your tables are at the end of chapter 5. So if you find the end of chapter 5, there are some light green pages. And there, in those light green pages, there are 5 tables. It's after chapter 5. It's light green pages after chapter. See this module of time value of money? And you're going to need these for the finals, so you might as well. Well, actually you won't, because I'll give you the factors. All right? So does everybody find those? It's light green pages after chapter 5. Yeah, there they are. Okay? All right. Okay, so what you need to do is compute the present value at a discount rate of 16%. So I is equal to 16%. N is 4 because you're making 4 quarterly payments. So the first question is what table are you going to use? 3 is the present value of $1. Is it just, that's a single payment sometime in the future. But we're not doing a single payment. We're doing 4 payments. No, that's a future value. We want present value. That's future value is if I take $1 and I start saving it. 4, yes, matter of elimination. Table number 4. All right? So table number 4 is the present value of an ordinary annuity. An annuity is an equal payment received over a period of time. Multiple payments received over a period of time. So we know that the period of time is 4, which is going to tell you what row, what column are we going to use?
Or no, 4.
There we go. Why 4?
It's 4 payments.
4 payments within a single year. So this is the annual rate, so really we want to look up 4%. And if you look up 4%, column 4% down to row 4, you should find a present value of 3.629895. The payments equal $20,000. If you multiply the factor of 3.629895 by the $20,000 payments, you get a present value of $72,597.90. So your debit is to machine and to discounts on notes payable. And then your credit is to notes payable. So what's the total face value of the note that we're signing?
725.
No, that's the present value. What's the face value? $80,000. The 4 payments at $20,000 each. The present value is the $72,597.90, which is really what we bought the machine for. Because if we're paying it in, God bless you, if we're paying it in 4 equal installments of $20,000 over the next year, in actuality, our arm's length negotiated price for this machine is the $72,597, because that's what it's worth today when we take possession of that machine. The difference is the discount, $7,402.10. So the next step in this is to calculate the effective interest on this note. For that, we have date, we have payment, we have interest, at 4%, and we have principal payment. Leaving us with a balance in the note payable. So on January 1, 2013, when we bought this machine, the note payable effective balance, because this is a contra liability account, so you take the full $80,000 and subtract the contra liability, and you get the balance of $72,597.90. We're going to make quarterly payments. So the first quarter is March 31st, 2013, and we're making a payment of $20,000. Everybody with me so far? If you multiply the $72,597.90 times the effective interest of 4%, you get interest expense of $2,903.92. Subtract that from the total payment of $20,000, and you're going to reduce this note payable balance by $17,096.08. That brings this down to $55,501.82. Repeat the process. June 30th, 2013 is the end of the second quarter. Same $20,000 cash payment. Only now when we multiply the 4% times the $55,501 balance, we get interest expense of $2,220.07. That gives us a reduction in principal of $17,779.93. $37,721.89 is the remaining balance. On September the 30th, 13, we have 20,000. Multiply it out. We now are down to only $1,508.88 worth of interest. $18,491.12, and we get $19,230.77. Our last and final payment on New Year's Eve. We now only have $769.23 of interest expense that has accrued, and we get the same $19,230.77, bringing our note payable balance to zero. Yes, sir.
Sorry, I was just thinking about the final. Is the final cumulative, or is it just...
Nope, just the chapters that were covered since the last midterm, yes. So there's 4 chapters in keeping, but you now have 2 hours to do it, so it's the time is not as big a constraint. Okay? So a journal entry, and I'll just do the March journal entry, is we're going to book the interest expense. We're going to debit the notes payable for the reduction in payment there. So that's the full $20,000. We're reducing, because 4 reductions of $20,000 will wipe that $80,000 out. We had $2,903.92 in interest expense. We're going to reduce that by that same amount, the discount. By the $2,903.92. And then we have our $20,000 credit to cash. And then you would repeat that same basic entry for the remaining 3 quarters throughout the year. So at the end of June, your interest expense would only be $2,220.07. Your reduction to the discount on notes payable would be the same, $2220.07. The note payable and the cash entries are the same, $20,000. And you would do that until you got to the end at 12/31, at which point your discount and your notes payable would both be reduced to 0. Okay? Does this make sense? A little bit? Okay. All right.
So the homework assignments are going to be due on Sunday?
Yes. Yes, it is. Okay, the last major topic in this chapter is compensated absences. So let's do problem number 11. No, I'm sorry, exercise number 11. On page 38. All right, on this one, Betting House Corporations began business on January 1, 2013 with 5 employees. Its sick leave and vacation policy follows. Each employee is allowed 8 days of paid sick leave each year and 1 day of paid vacation for each month worked. Accrued annual vacation leave cannot be taken until the employee has been with the company for 1 year. The sick leave, if not used, accumulates to an 18-day maximum. So if they get 8 days a year, about 2.5 years later, they'll max that out if they don't take a single day. Well, actually, 2 years and a quarter, they'll max that out. Vacation leave accumulates for 5 years, but at any time they may request additional compensation in lieu of taking paid vacation time. I always loved companies that would allow you to do that. You know, just don't take a day off and extra cash. Company records records its liability for both compensated absences on a quarterly basis, and the gross daily wages for each employee is $160. So they want you to do the first quarter 2013, assume that no sick time has been taken by the employees. So what is the compensated absences? And we'll do 2. We'll do 1 for the sick leave and 1 for the vacation leave. So the sick leave is going to be a debit to salaries expense. And a credit to the liability for compensated absences. So we have 5 employees times $160 a day times 8 days a year times 1 quarter, because we're only doing the March 31st entry. All right, if you multiply that out, 5 times 160 times 8, and then divide it by 4, you get $1,600. Then you're going to do the same, salaries expense. Liability for compensated absences. same 5 employees, that should be an M, times their $160 a day, times 3 days in the quarter. All right, 3 months and a quarter, 3 days of vacation each employee. Multiply all that out, you get 2,400.
Also, the second one that we're doing is for vacation.
Vacation, yeah, this is sick. And this is vacation. Day. Sort of day, but I started writing a B for reasons unknown, and so I tried to save it, and it turned out to be unreadable. Yeah, who knows? It's something, some sort of scratching on this. All right, questions? Those are the 3 types of problems. Know how to do payroll, know how to handle a present value of a note, and know how to do compensated absences.